Welcome to today's Canary Report from June 22nd, 2026. Markets are in defensive mode as investors weigh midterm election uncertainty against a Fed that's clearly done pausing for now. We're seeing classic risk transfer behavior with small caps rallying while mega-cap tech drags the broader indices lower. Let's see what our canaries are telling us about where capital is flowing next. Speculators are getting picky rather than broadly greedy today. The Mag 7, MAGS is down 2.23%, while ex-Lowy consumer discretionary has been hammered 3.4%, suggesting retail and consumer confidence fatigue is real. But notice ARKK Innovators dropped 1.95%. Speculative innovation is getting squeezed, as investors prefer proven earnings over hype cycles. The bright spot is XBI Biotech, which surged 3.81%. This is defensive capital rotation into healthcare. People are buying biotech when they're worried about the real economy, because it's hard to argue against a sector that provides essential services and has strong long-term secular tailwinds in aging demographics. SPHB held positive at plus 0.44%. Showing mid-cap value still has some floor support even as mega-caps bleed. Credit is getting nervous about the yield curve inversion. High-yield bonds are down 1.89%, while HYG investment grade barely moved, 0.08%. The spread compression between these two segments indicates institutional investors are worried about corporate refinancing risk as we move into late summer earnings season. When you see inverse credit, HYGW, holding steady at plus 0.14%, that's a signal that active traders know something. They're hedging their exposure rather than going all in on credit recovery. The 10Y Treasury moved up 1.3% to 4.51, which is the yield component compressing into the price multiple compression risk we talked about last week. Credit markets are watching PCE data this week closely. Any surprise and you could see a double-digit percentage move in the junk bond space. Fear has peaked for now but hasn't broken through yet. UVXY dropped 0.88% as VIXY declined 0.18%, meaning leveraged volatility plays are being trimmed by short-term traders who bought into the election spike trade last week. VXX, the 7 VIX ETF, was hit harder at 1.23%. Suggesting institutional players are unwinding their gamma exposure. The VIX itself ticked up 2.98% to 1728. Still below its 30-point panic threshold, but enough to keep option premiums elevated. What's driving this is a mix of geopolitical uncertainty from US-Iran talks and technical stop losses hitting in the Nasdaq after that 1.32% drop. The key observation: fear is asymmetrically loaded toward downside moves, meaning any positive surprise will be priced more quickly than negative news. The real economy engine is humming unevenly but not dying. SMH semis gained 1.21%. AI demand and chip cycle recovery are still real despite the recent pullback. IWM small caps pulled up 1.03%, showing that companies with lower debt loads and domestic revenue exposure outperform when growth uncertainty dominates. Industrial stocks, IYT, moved plus 0.79%, while regional banks added plus 0.56%. This tells me capital is finding value in traditional industries where earnings visibility is better than in tech. RSP, the S&P 500 Equal Weight Index, barely budged at 0.25%, meaning mega cap drag is what's hurting broad indices rather than a fundamental deterioration across all companies. The Goldilocks economy narrative from that headline is playing out. Inflation cooling without recession, but investors are demanding higher compensation for holding riskier assets in this intermediate regime. Safety isn't an outright flight yet, but it's being tested. GLD gold held essentially flat at plus 0.08%, showing precious metals have a floor but aren't attracting fresh inflows from macro traders who need bigger moves to justify the transaction costs. TLT long-duration treasuries declined 0.74%. When you see duration bonds get hit while short-term yields climb, that's yield curve inversion risk pricing in. The broad bond index is down 0.33%, suggesting even core fixed income positioning is getting squeezed as investors demand higher coupons for inflation protection. XLP consumer staples dropped 32%. Defensive sectors are being beaten on earnings expectations rather than sentiment, which means fundamentals might be softer than they appear. The interesting rotation: money went from mega-cap tech, small caps, biotech, industrial staples. That's a 3-step capital migration, suggesting investors think the worst of the tech correction is in, but want to build positions gradually across defensive growth sectors. The market is pricing in a slow, earnings-driven recovery, rather than a quick V-shaped bounce. Mag 7 weakness, combined with rising yields and midterm uncertainty, means we're in a selective rotation phase, where capital favors companies with visible earnings, strong cash flows, and reasonable valuations, not just momentum plays. The Canaries suggest 3 things. First, XBI biotech strength indicates defensive growth is the theme. Second, credit stress implies PCE data this week will be closely watched for any surprise that could trigger volatility spikes. Third, small cap outperformance, IWM plus 1.03, signals institutional money is still deploying but more selectively than last quarter. That's your Canary Report for June 22nd. The overall sentiment is cautiously defensive, with a bias towards sectors where earnings can support valuations: biotech, industrials, and select mid-caps that haven't been beaten down yet. Stay tuned to PCE this week and keep an eye on how the Fed responds if inflation shows any surprise acceleration. We'll see you tomorrow.